Hey, Dave Matta here, founder of PT Biz, and one of the things I spend most of my time on when I'm consulting with clients these days is finance, especially when people are looking to expand their business, and that's exactly what we're going to get into today. So we're going to talk about ways in which you can capitalize expansion in your PT clinic as you're growing. And we're going to talk about two primary ways you can do this, the pros and cons of both, and maybe scenarios in which you want to use one or the other, or sometimes using both together. So we're going to talk about a line of credit, and we're going to talk about an SBA expansion loan in particular. Now, if you are listening to this on the podcast, this may be one of the ones that you want to head over to YouTube for and actually watch the video, because I'm going to get into a little bit more specifics around some of the math with these. But if you're more of an auditory learner and you don't need the visual side, that's cool too. You can always use it as a reference. So this is an area that I can tell you, I learned a lot of what not to do, but really the hard way. So when I work with our clients and we're helping them with expansion, it's a really important part of the growth cycle of the business, especially when you look at the first expansion cycle. So most people are going to bootstrap, meaning they're going to take any money out. They're going to self-finance the start of their cash-based clinic, usually in like a sublease space, which is very inexpensive. And there's a lot of pros to that, right? But as your schedule gets busier, you need to make the decision of, do you want to stay and this be a lifestyle business, super low overhead, but obviously very limited upside? Or do you want to grow into a standalone space? And in order to do that, how are you going to capitalize it? Because you can self-finance, which is, that is one way to do it. That can be a bit of a sketchy way to do it, and I'll explain why. There's also lines of credit, and then there's expansion loans specific from the SBA, or Small Business Administration. So that is a government-backed business loan, and I'll talk about the specifics of that as well. But these are the two options that a lot of people will use, and the ones that we typically recommend. But if you want to self-finance expansion of moving into a space, you have to keep in mind your cash that you have is it's like your lives in a video game. Okay, so back in the day when I was a kid, I was playing a lot of like Mario 3, right? And fantastic game. Get the warp whistles, get to the end, all that stuff. My brother and I were obsessed. But you could get extra lives, right? And that was really important, especially as you were trying to beat the game, because you need the extra lives because you're gonna die at some point in time, and you need the extra lives so you can stay in the game. Cash for entrepreneurs is like extra lives in Mario as you're trying to beat these different levels. So the ability to tap into cash is very important during periods where you're going through growth cycles. Here's a perfect example. What if you decided in 2019 that this was the year that you need to aggressively expand your business, and you decided to use all your cash reserves to do so, and then all of a sudden March 2020 happens, the world shuts down, and there's nobody lending money to businesses. Nobody's going to give you a line of credit. SBA, for the time being, shut down. They're focused on what to do for PPP loans and lots of other things. You could end up going out of business because you run out of cash. So cash flow management is very important, and you don't know when things are going to happen, both positively and negatively around the world. It is what it is. So you need to be very conservative of cash management in order to stay in the game. The whole point of this is to stay in the game, right? We want you to grow to wherever your vision is, but not get kicked out of the game because you ran out of lives, right? And in this scenario, it's cash. So cash is very important to conserve and have access to. Even if you don't think you need it, it's still very important to have access to, because it gives you options. And I'll talk about some of that with this as we get going. But let's talk about the two ways to capitalize. I prefer people don't necessarily just bootstrap expansions. You can, for sure, but I prefer you keep that cash, you borrow somebody else's cash, and you pay that back over time so that you have more likelihood of staying in the game because you have your cash. So capitalization and expansion options that we have, there's two that we talked about. So we got a line of credit, all right, and then we have an SBA expansion loan. So let's talk about the two, what they are, and then I'll give you some scenarios of what they're best used for, because it might apply to the type of expansion you're going through, right? So a line of credit, you usually get this at a bank or a credit union. Usually in most cases, people get this wherever they have their business bank account, but you don't have to. You can get a line of credit from another bank. They usually want you to have an account there. It's definitely a way in which they try to establish more of a relationship, but you can get a line of credit through many other third-party lenders. But the pros of this are they're flexible, right? You can get these really fast. They're super flexible, fast access. Like if you have, if I wanted to go to whatever our business bank right now and say, hey, I need a line of credit for $100,000, like they would, cool, it's available when you need it. Go ahead and go for it, right? But it's because for the bank, it's great. It's variable interest. It's tied to the prime rate, which the prime rate is essentially the borrowing rate in which everything is based off of for banks and for the SBA. And it's going to be prime plus a certain amount. Okay. So prime right now is 7.5%. So a line of credit is going to be on the low end, 9.5%. That's on the very low end. And on the high end, it's going to be closer to like 14. So because it's going to be prime plus 2 to 7% roughly. It depends on what you're borrowing. It depends on your credit history. It depends on your history with the bank. There's lots of factors that go into it. But normally it's going to be towards the higher end of that. So usually a line of credit is going to have a higher interest rate. And again, it's tied to prime. So it's variable, meaning if the prime rate goes up, which has happened over the last few years, it's gone from like 4.5% to 7.5%. It's been as high as like 8.5%. But so, if you have a line of credit and you're borrowing that money and then the prime rate goes up, what you're paying interest on goes up as well. The percentage of interest you pay goes up as well. So it's variable. And it's also, it's not a set amount of time that the payment is paid back, right? So this isn't a 5-year, 10-year set term. This is literally flexible. You pay back what you want, but if you don't pay it back, the interest accumulates, right? So it's like a credit card basically, but it's lower interest rate than that, but it's very flexible. So you can use it for many different things. So you repay this as much or as little as you want. So this can be a real advantage for businesses that are going through expansion cycles, because what you might have is a period of compression as far as like net profit is concerned, because you're bringing on additional overhead and staff and equipment, software maybe. So, as your top line gross revenue is going up, your net profit, like the total amount of net profit percentage wise, is going to go down during that time because you're reinvesting heavily in the business. And as that starts to stabilize, your net profit comes up, and that's a period of time where maybe paying these back quickly can happen. But there may be a period of time there where you want the flexibility, and that can be a really valuable thing as long as you pay it back. This is where people get in trouble: is they take these loans out, they take these lines of credit out, they don't manage them well, they don't pay them back well, and this in particular, there's no set payment each month. You have to engineer that in yourself. So this can actually be a negative for a lot of people. And then collateral, sometimes it requires a personal guarantee, but it just depends on how much you're taking out. Because if you have equipment in your business that can offset that, and maybe they take that as collateral, you don't have to have a personal guarantee, but oftentimes they want a personal guarantee. That means that you're on the hook to pay for this, even if the business, can't support that with their own assets. So a personal guarantee is something you probably are going to have. So there's a bit more risk associated with that. But that's just the kind of businesses we have. We're very lean as far as assets are concerned, and much more, people heavy, right? So service businesses. So anyway, these are sort of the characteristics of this type of a vehicle. The other one is an SBA Express loan in particular. There's a number of different SBA loans, but the SBA Express loan is designed for expansion primarily, right? And there's some criteria around this that you may not even apply for. You may not even check their boxes, right? So that you need to have been in business for a period of time. I believe it's 2 years. Like there's a specific amount of credit history that they want to see, a credit number that they want to see above a certain amount. And what is nice about this is it's structured, so it's a lump sum, okay? And you can get up to $500,000, which the amount you qualify for depends on how much net profit you have in your business. So it's a multiple of the net profit. They call it a debt coverage ratio. All right. And so I'm not going to go into how they calculate that, but you could get up to $500,000 honestly, as we've helped people apply for or get these loans with like the clients we work with, we actually have a direct relationship with a healthcare lending bank specifically that allows us to sort of streamline this process for our clients, as well as we are able to help create really beneficial terms for them. And I'll kind of talk about like what those look like, because you may be able to negotiate these yourself. But the ability to get $500,000 in an expansion loan it's kind of hard to come by that in a number of different ways, right? This is a really great loan option, depending what you use it for. But when we look at this, the ability to get a big chunk of money, and that is like it's flexible. You can use it forever you want. That is a real value to this loan. It's also fast access. So if you were to get like an SBA startup loan, it's months and months, lots of documents. If you were to get a loan to buy another business, same thing, like lots and lots of paperwork. It's going to take months. But because this is an expansion loan, it's faster. So that's why they call these express loans. And what's cool about that is normally people can get funded. They can finish the process, get funded within 2 to 4 weeks, which is way faster than a traditional SBA startup loan would be, right? And then the other nice part about this, honestly, like I like the fact that there's set monthly repayment amounts. It's like a mortgage, it's like rent. It's like, we're used to this, a car payment, whatever. Like it's a certain amount. You don't have to think about it. You don't have to sort of manage the loan. You just have to pay it every single month, right? And there can be pros and cons to that, because maybe you have fluctuation in your ability to repay during aggressive expansion cycles, but knowing what you owe is nice. And it can change a little bit, just like a line of credit, which I'll talk about here in a second. But typically, this is going to be over a 10-year period of time. So let's talk about debt for a second, because not all debt is the same. There's terrible debt. There's debt that can be really positive. When we look at expansion loans, when we look at your ability to borrow money and to put that in and reinvest that into your vehicle of your business, to then generate more income, more growth, more jobs, more just size in the business. That is a very intelligent use of capital, assuming you know what you're doing. Okay, so here's the thing with these loans. If you take $500,000 out and you have no idea what kind of ROI you can expect on marketing, what size facility you need, the expansion that you're moving into a space, the demographics of the area, how you're going to hire, being very clear on your KPIs and what your goals are going forward and why you need to borrow that much money and what you're going to use it for, please don't take a loan out. Like, it doesn't make any sense. You don't even know what you're doing. It would be like you going out and buying a Porsche 911 that's a manual, and you don't know how to drive stick. Like, don't do it. You're going to ruin the car. I'm a big believer in these loans in particular, because most of the requirement is you need 2 years in business before they'll even allow you to apply for and get one of these loans. So that means you at least have 2 years of history of showing that you're not, going to screw this up and put yourself in a terrible financial position. But the 10-year period, what's nice about that is it's very drawn out. So when you look at loans, you want to borrow as much money as you can, assuming you're going to be able to use it effectively, over the longest period of time possible, with the lowest interest rate possible. And if possible, a low fixed interest rate is even better. This is why a 30-year mortgage is like a gift to people. And in fact, Warren Buffett I think it said this is like the greatest financial gift that people can get is a 30-year fixed mortgage. And it's because you have 30 years. You have 30 years for the house, where that house probably appreciate the amount because of inflation of what each dollar is essentially worth. It goes down, meaning the amount you're paying is fixed, but each dollar is becoming less valuable, slightly less valuable each year. So by the end of that 30th year, it's just like nothing in comparison to the first year. All right. So when we look at these, we say like the most expensive year for a loan is the first year, obviously. That's where you feel it the most. But if you can find a vehicle like that, that's the best option for borrowing money. Now, the negative for this, or one of the drawbacks, is not fixed interest, right? So this is lower interest than a line of credit, but it's still tied to prime and it's variable, which could be, in most cases, it's not as ideal as a fixed rate. But what we have to think about is, what are you trying to do with that? And are interest rates probably going to go up, or are interest rates probably going to go down, right? Because that's really what we have to keep in mind, is where are we at as far as interest rates are concerned? Well, we're probably going to go into a lowering interest rate here pretty soon, which is really going to be a better place for you to be financially if these are tied to the interest rates going down, right? So that's something to keep in mind. If you think interest rates are going down, this could be a really positive thing. All right. And again, there's also going to be a personal guarantee assigned to this. And that's just the way it is. There's really no way to get around that. So personal guarantee, it happens. And you gotta take on the risk of these assets in order for that to actually, help the business grow and scale. So, okay. When do you use these suckers, right? Well, they kind of fit different scenarios, one better than the other. A line of credit really is great if you have smaller needs, right? Let's say you don't need as much. Let's say you need access quickly. You aren't exactly sure what the costs are going to be. That is where you can get a lot of value from these loans because they're flexible. And with them being flexible, it allows you to really, pay back as much or as little as you can at any point in time. If let's say, you need a cash buffer, this is actually a really good way to use a line of credit where if you, let's say, want to increase your cash reserves as you're going into an expansion cycle, you can get a line of credit, not actually draw from it. So meaning you're holding it in your account, but you're not borrowing it. So you have access. Let's say you have access to $50,000 of a line of credit. It's almost like a secondary cash reserve, but you're not tapping into it for loan purposes and you're not paying interest on it if you're not using it. Versus if you have a fixed rate loan, you're paying interest on that whether you're using it or not. It's just sitting in the account waiting to be used. So a line of credit is really good if you have variable costs. You don't really know what it's going to cost, and it's really good if you don't need as much. So let's say you're opening a satellite office and it's going to take $15,000 for you to actually build this new space out. That is a great use of this. So $15,000, maybe you need equipment, you need cash to ramp your staff up, maybe you have additional overhead, things like that. That's where it can make a really big difference. And it's something that for a lot of people, this can be the perfect loan vehicle for them as far as a small expansion is concerned. And again, extra cash for a buffer, this is a big one. It's just sort of makes you feel better knowing, okay, I have access to this cash. We keep a line of credit open in our businesses. I've only tapped into it one time, and that was actually during expansion period. But we always have it there because it's an additional cash reserve. Again, think of the extra lives in Mario, right? You're keeping that extra cash on hand. So just in case, and it's security during growth cycles in particular. So the SBA, what's that best for? Well, the SBA really is best for bigger projects, bigger build outs. So let's say I'm building out a full standalone space. Let's say I'm moving into a 4,000 square foot standalone space. I want to dump a couple $100,000 into the equipment, the design, the branding. I want additional overhead, cash reserves to buffer the cash reserves that I have. And I really want to really go for it, make it look really nice. And I'm building a space I'm going to be in for the next decade, right? This is where that works really well. So being able to actually have a cash reserve for that is huge. And again, this is a fixed amount of money. So you can get a lot, up to $500,000. The other thing, and this is actually a lot of people, I'm seeing this happen now, they have more of an opportunity for this, is potentially even buying an existing clinic. So you can use this as an expansion loan, but it's not as stringent in terms of limitations of what you can and can't use this for. So let's say you find a clinic and you can buy this clinic for $100,000 and somebody's just they're tired of it. They're on their way out. They have a big patient list. It's in an area you want. The space is built out. Well, you might be able to buy that clinic outright, and now you own this other asset, which is another clinic, from an expansion loan that you have. So there's a lot of options with this. So anyway, in summary, both these have their place. And what you got to keep in mind is what's the intent, but also understand what are you using this for? Because you can use both, you can have both, but you got to know the math and the purpose of this. So hopefully this helped. This is an area that we help a lot of people with on the finance side. Again, if you're listening on the podcast, make sure you check out the video. I think it'll be really helpful. And as always, thanks so much for watching. Thanks so much for listening. We'll catch you next time.